Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about Mr. Buffett on the stock market. This is not any new interview that he's given, but rather something from November 22nd, 1999. I wasn't born then. It was probably half a decade.
I was in 9th grade.
You were in 9th grade in 1999.
Yeah, and I wasn't reading this.
So it was quite a while back. But that being said, let's look at what Mr. Buffett had to say back then. And maybe in the next part of this video, we'll look at whether we can take some of those insights, analytical insights, and examine where we stand today. So what has Warren Buffett said back then? So there's a few things he said. First of all, Warren Buffett never talks about where he thinks the market is going to go. That is something Warren Buffett never does. And he only a select few times in the past has he said that the market is either overvalued or undervalued. He does not make predictions. He doesn't say that the market is going to fall on, let's say, 4th of May, 2025. He's not going to make such predictions. But he will say that today, on whatever day, August 2024, the market seems to be overpriced and it has run ahead of earnings. This is something he has talked about before, and this is one such piece. And if the sharp ones at home might remember that 1999 is before the dot-com bubble crash which happened.
Before the Y2K.
Yeah, before Y2K, and before this is November 22nd, so very close to Y2K, and before the dot-com bubble crash which happened. So Mr. Buffett has said in the past that, look, the market is overvalued where it stands today. And let's look at how he came to this conclusion so we can take a look at how to use these tools for ourselves. First of all, he says, let's examine the Dow Jones Industrial Average from 1964, December 31st to December 31st, 1981. Most of you might be saying, look, who cares about that period? Like, that's so long back. But trust me, if you stick with this and we look at what tools he uses, we can use those tools now. So it's very useful. So he says between these two periods, in 1964, the Dow Jones Industrial Average was $874. In 1981, it was $875. The market went up by a total of $1 within that period. Let's say you don't count dividends. Even if you counted dividends, you'd probably get 2-3% per year max. So in 17 years, the stock market went nowhere. During the same 17 years, the GDP quintupled. That's almost 5 times. A quintuple meaning 5 times. It went up 5 times. And that's a huge number. It's a crazy number. And the economy did well during the 17 years, but the stock market remained behind. So what exactly happened? I mean, why had the Dow Jones Industrial Average stagnated during that period? Well, simple answer. First thing, interest rates. So the fact is that the higher the rate of interest, like gravity, the downward pull is greater. So that means stock prices remain low. And again, for those of you at home who have been watching this channel for a while, you'll remember that we've talked about this figure called Paul Volcker. He was the one who brought in very high interest rates in the US to curb on the very high inflation rates in the US. So when the inflation rate was running ahead, Paul Volcker decided to step in and do something which no other Federal Reserve governor since has had the mettle to do. Maybe Jerome Powell is different. But apart from Jerome Powell, no other Federal Reserve governor has had the courage which Paul Volcker exhibited during that period by raising rates up to, I think, much more than 8%. But basically, you get it. It's a huge amount which raised it to. And that basically meant that the risk-free rate of return went up. The risk-free rate of return is how people discount their returns back to today's number. So if the risk-free rate of return is giving you, let's say, 8 or 10%, what incentive does he have to buy an overpriced stock from me at, let's say, 2%, 3% return when he can get 8%, 9% just by buying a treasury bill and sitting tight at home? I mean, provides no incentive for him to even buy that. He'll spit in my face and say, look, you better give me a good return. Otherwise, why am I going to take on risk? I'll just buy the US treasury. I know the government cannot go bankrupt. I'll hold this treasury, I'll get a good return. I don't want to do anything with stocks.
Zero risk also.
Zero risk. And that's what happened. A lot of people dumped stocks and said, why would I hold this risky asset? We saw what happened after the Great Depression. We saw what happened after the Great Bull Run in the 60s. I'm done. I don't want to touch the markets. I'm good holding, risk-free bonds, T-bills. And
also another side of the coin is people who do like taking risks will find it very hard to find money because money has become so expensive because of the rate of interest you're being charged for every dollar you borrow. It gets very scary to take any kind of leverage or stand in any position where you can get hurt because it's like one punch man. One punch is going to destroy you. So you would rather not take a punch and skip the whole thing altogether. So that's the other side of the story. So even if you say investors would say like, why should I bother and take on risk? Even if you are the guy who likes being like James Bond or Tom Cruise running down a hill and jumping off a cliff, you would be very scared to do it because Earth's gravity suddenly went up by tenfold and you won't want to risk sticking out your head.
And 17 years is quite a long period. I mean, if you take humanity as like a whole thing, it's probably a very small period. But if you take any one of our lives, 17 years is quite a bit.
Yeah, if you were born when you started at the age of 3 or 4, let's say you were, and you started raising up the interest rates, you'd be well in your 20s by the time it came to any idea of closing. So you would have lived through such high interest rates. You would never imagine a time when interest rates, like Howard Marks.
Yeah. I mean, that's the problem. The problem today is that most people have only witnessed one thing in their life, in the markets. They haven't witnessed 2-3 different events in 2-3 different cycles, which is why it's hard to fathom that the market can go down sometimes. So
let's get back to the article.
Yeah. So between 1964 to 1981, the interest rate rose from 4% to all the way to 15%. Then there's no mystery as to why the Dow Jones Industrial Average didn't move up. Even though GDP went up, it quintupled. So it had a depressing effect on the price of your investments. And another important thing was the fact that if you had bought bonds during this period, the 15% interest rate, long-term bonds for 30 years or some long number, late maturity, by the time interest rates started cutting, because yes, it's a cycle, interest rates do go down after it stays up for a while. And when it got cut, what we saw was that your $1 million, if you had put in money back then, that would have gone all the way to $8 million in just another 17 years. So by 1998, you would have sat comfortably at $8 million with your $1 million of principal investment which you had done. And the assumption is you will reinvest the coupons which you're making off the bond. So this is a 13% return, annual return on your bonds if you had done that for 17 years. And this is a crazy result. It's an amazing result. 13% year on year in the US dollar.
We'll take that.
Yeah,
today we'll take it.
And you're in bonds. Remember, you're not taking any risk there in the sense that the US government is not going to default on your treasury bills. They can just print more money to pay you back. So this is one thing. Now, let's look at the flip side of it. If you'd invested $1 million in the Dow Jones in 1981 and reinvested all your dividends until 1998, your $1 million would have been $19.7 million. So then those of you at home then might ask me, what the hell was the point of this? Like, why did you tell me that you should have been in bonds when I could have just bought stocks? The problem here is the fact that you would have been better off in bonds during that 17-year period because you can't predict when the 17-year lull where your Dow Jones Industrial Average doesn't go up by even $1 comes in. Because you have to understand which part of the cycle you're in. And that's what Warren Buffett talks about. And he basically in this memo, he said that we're ready for a crash. We're ready for the market to take back some of what it's given you. And when this crash comes, it's going to be very, very painful for a lot of people, especially those who believe in this .com story, which they're sort of buying into. And during the second 17-year period, from 1981 to 1998, he says tax corporate profits as a percent of GDP has not gone up, it's actually gone down.
Correct.
So the market has performed well, even though the GDP did not go up by as much as it went up in the last 17 years, neither did the percentage of corporate profits of GDP go up either. So the pie has remained, it has grown considerably slower, and the slice of your pie hasn't grown either.
No.
So, but the market has performed very well during this period. So he's trying to highlight that there's a paradox here. So he's trying to tell you that it depends on whether you buy the Dow Jones or rather the stock market. the broad market, if you buy an index, it depends on whether you're going to buy it when it's undervalued or whether you're going to pay like a premium amount of money for when you're going to buy it. You could have bought it in two different instances. The first 17-year period when GDP quintupled and you have sky high interest rates, of course, but you have quite good valuations on your stocks. Or you could have bought it in the second 17-year period at the end of it when the GDP did not quintuple, only went up at a much slower rate. And the fact that only thing which was boosting the stock market was the fact that interest rates had been lowered since Paul Volcker's time. So what Warren Buffett says is investors are projected out into the future what they were seeing. They have this unshakable habit looking into the rear view mirror rather than into the windshield. So he says that we were projecting sky high interest rates and we were projecting low profits. And that's why the Dow Jones was at the level that it was in the first 17-year period. Whereas after the second 17-year period happened today, that is as of 1999 when this article was written, he says, today we're standing here. You've seen the past 17 years where the Dow Jones roared ahead and you would have made $19 million if you had put in $1 million. And today you're saying that, look, the market is going to give me very similar returns in the next 17 years. But what Warren Buffett is trying to tell you is that, look, it's a cycle. You were caught in a good cycle this time. You may get caught in a bad cycle the next time.
What he's saying is you're looking at the rear view mirror and driving forward.
Yes.
It's not even doing backward driving. What you're doing is you're looking at the back and blindly going forward like this. And you know what that is. You will not go anywhere very far. You'll end up getting hammered very soon. This is what Sashwath is saying. This is what was
Warren Buffett saying. And he says there are three things which you may need for the market to go further from where it is today. He says, look, people are new to the market, expected to grow and give a return of 22% per year from then on. And now we know sitting in 2024 that the market went nowhere near that. It gave you nothing close to that, either in GDP growth, dividend growth, or earnings growth, or even price growth. None of that gave you that kind of return. He said three things. One, interest rates must fall further. Two, corporate profitability in relation to GDP must rise. A larger portion of the GDP pie needs to be eaten by corporates. And if the larger portion is eaten by corporates, that means your stock market is going to do better. Or the third factor, the general economy itself has to grow at a much faster pace. So what Warren Buffett is telling us here is that regardless of what people tell you, what your stock broker tells you, your asset cannot grow faster than what the underlying earnings is growing at for very much long. In the sense that there can be speculation, your asset price can go up, your PE ratio can go up, but it can only go up to a certain extent, after which fundamentals will start to matter, be it today, be it tomorrow, be it in another 5 years, but fundamentals will end up mattering. And if your earnings growth isn't giving you more than 5%, it's very difficult for your price growth over the long run to be more than 5% annually. This is what Warren Buffett is saying, and I wholeheartedly agree with it.
Yeah. So you may ask now, so if all this is true, if Warren is saying this and Sashwath is also agreeing with it and saying, yes, this is a way to look at it. So what's the point of looking back at history altogether? And this is true for all things in life. It's just not true for stock market. We as human beings have a tendency and this fallacy and false belief that whatever we see at the back and we drive forward in life, meaning we live our life through the experiences we have had in the past. Experiences in the past, market experiences or life experiences have value. What value does it have? It tells you what to do when the same situation arises. But what we fail to realize is, it only tells you what to do when a situation arises. It does not tell you when the situation will come. So, it's like when you had a speed breaker on the road 5 kilometers back, you knew what to do, you reacted, and that is in memory fresh. But there is no guarantee 5 kilometers from now there will be another speed breaker. What Warren is saying is, next time you see a speed breaker, those are the 3 points Sashwath was talking about, then you know what to do. So if you see these 3 conditions appearing in front of you, the hazard sign coming on the road saying road bumps ahead, and you can see other cars in front of you slowing down, then okay, speed breaker is coming and you start decelerating and you start reacting. Correct? The same way is what previous information about the market, previous experiences you've had in the market can help you in the future going forward. Especially when you have not lived in a time of high interest rate. You have been in a generation which has been living in low interest rate like Sashwath, and you've seen only low interest rate, and all this is new territory for you. So that doesn't mean your past doesn't have any value. The value it has is, it tells you how to react to a situation. But what it does not tell you is when that situation will come. So keep that in mind.
And finally, he says, one more factor, one important factor which all of us fall into. It's a big hurdle: ego. We think we are going to be the one to beat the market. We have some knowledge which others don't, which where we can go out and we just pick the obvious winners. That's common sense. A lot of people have come told me saying that, look, why are you spending so much time figuring out PE ratio, this, that? AI is going to be a big thing. And we'll talk about this in the next video. But there's this obvious sector which is going to do very well because it has breakneck pace of research. It's doing very well. Regulatory hurdles are being jumped. Why don't you invest in this sector? It doesn't matter what you buy as long as you buy this sector.
We'll discuss that in greater detail in the next chapter.
And why this may not make too much sense. But that being said, Warren Buffett's article is almost prophetic. I mean, it is prophetic. He predicted a crash, and I think just a year or two later, the crash came, and it came in a massive way. And after that, there's been 2 other crashes since when he spoke. And in fact, there's a quote here. He says, when I imagine what this talks of 17-year periods makes me think, what could a current brood of these critters, that is locusts, scheduled to take flight in 2016? So there are these locusts which have a very long gestation period, which is about 17 years, and they only come out of the ground after 17 years. So he says when these critters come out of the ground in 17 years, what will they see in 2016? 2016 looks like a long time ago now.
From that time.
Yeah. But what could a current brood of these critters say? Scheduled to take flight in 2016, expect to encounter. I see them entering a world in which the public is less euphoric about stocks than it is now. Naturally, investors will be feeling disappointment, but only because they started out expecting too much. Grumpy or not, they will have by then grown considerably wealthier simply because the American business establishment that they own will have been chugging along, increasing its profits by 3% annually in real terms. So true. I mean, since the 1990s dot-com bubble and the 2008 crash, in 2016, if you look at the S&P 500, a lot of people, when Donald Trump was elected back in, during that time, no one was raving about stocks. Most people said, look, 2008 crash just happened, dot-com bubble happened. The stock market looks a little dangerous. He was so right. But today we're back to the phase in the cycle where today we're saying...
To the point we even now will talk about 2016. Like, what are you saying? We were different.
Yeah. So that's where we stand, and it makes a lot of sense. Those of you who just S&P 500 indexed fund, if you invested in the index fund in the S&P 500, you would have made a lot of money, 3% annually in real terms, and you would have been chugging along. So path to wealth and investment is very clear. It's up to us on what we do with this advice which Uncle Warren had given us so long ago.
Yes. We'll show you why this is relevant to today especially, and how it applies to today's market. What lessons we can see from history, and what learnings we can use, and what roadside warnings we can see now.
So that being said, thank you for watching this video. If you liked it, please hit the like button, please subscribe, hit the bell icon to be notified of when we drop our latest videos. Finally, if you have any opinions or comments, please leave them in the comment section below. We will make it a point to read your comments. Thank you very much for watching us on Be Rich.
Thank you.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate PT. See you in Singapore. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.